Hello all, welcome back to Engineering Economy. We are talking about evaluating a single project alternative and how to make a decision whether to accept a project or not. And in our previous lectures, we have seen the concept of MARR. We have seen present worth and future worth methods, and also we learned about annual worth analysis. And in today's lecture, we will continue our discussion on annual worth, and we will solve some examples, and we will also learn another method for evaluating single projects, which is the internal rate of return, IRR. So let's get started. So we are continuing our discussion on annual worth analysis, and we said that in annual worth, similar to present and future worth analysis, we convert the project cash flow into its annual equivalent version, and if this annual equivalent annual worth at each year greater than or equal to 0, we accept the project. Otherwise, we reject the project. And in the previous lecture, I told you that this annual worth analysis have some benefits other than the present worth and future worth analysis. But the thing is, this annual worth analysis gives exactly the same result, same solution with the present worth and future worth analysis. We said that we find the annual worth of a given cash flow for the whole project lifetime, which is N, by using MARR as the interest rate. And usually in all project cash flows, we have some annual equivalent revenues and some expenses like maintenance or operational expenses, and these revenues are usually due to selling goods and items. And then if these are equivalent at each year, we subtract their annual equivalent value by simply subtracting these costs, expenses from the revenues, R minus E. And then we calculate the capital recovery, which is the initial investment cost and minus the additional salvage value. Okay, so now if the annual worth is greater than or equal to 0, we accept it. Otherwise, we reject it. So here we said that CR is the capital recovery. We call it capital recovery. Sometimes it's called capital investment or capital cost. So what do? You know, when usually in these business ideas, in these projects, you have some initial investment to buy a land, construct a building, buy an equipment, and etc. And at the end of the project lifetime, what will happen to these equipment, machines, the building, the land? You can sell it in the second-hand market. So usually this initial investment has such a structure. You pay at the beginning for these equipment, tools, machinery, land, but at the end you sell it and earn at least some portion of the initial investment. So when we distribute this initial investment to annual amounts and the final salvage value to annual amounts, and then take the net value, it is called the capital recovery. Okay, and how do we find it? The capital recovery by finding for this initial investment value its annual equivalent, A given P. So for this one, we are distributing it to annual equivalent. And for this final, as you can see, the signs are different. This initial investment is a cost, I mean it's a cash outflow, but the final salvage value is a cash inflow. So their signs must be different. Actually, this initial investment, since it's a cost, this should be negative, but this should be positive. But the thing is, here this capital recovery itself is defined as a cost. Okay, so this capital recovery is a cost. So if I write here negative and this one is positive, then the value of capital recovery will be negative. What does a negative cost mean? A negative cost means a revenue, but it is not. The capital recovery itself is a cost. Therefore, I need to find this capital recovery as a positive one. Therefore, I am taking this I, the cost, as positive, but this S, which is a cash inflow, as a negative one. And what I am doing, I am distributing this future value of market value of S using this factor A given F to annual values. And since this is annual equivalent, and since this is annual equivalent, I am So this is how we calculate the capital recovery. As I told you, we have this initial investment. At the end of the project lifetime, we have the salvage value, and then we want to find its annual equivalent. The idea is this. So I'm distributing this initial investment to annual equivalent and this final salvage value to annual equivalent. But okay, you can easily find the capital recovery using this. But if you write the formula of this factor corresponding to this factor, and if you write the formula corresponding to this factor, and you do some mathematical operations, at the end you can find this formula as well. The capital recovery you can find by multiplying I minus S with this A given P factor, plus you add I times S. Again, this is exactly the same with this one. Nothing different, but this is just the reorganization of the previous one. That's it. And it will give you exactly the same answer, same result. And the thing is, when I say capital recovery, it is an annual amount. It repeats itself every year during the project lifetime, and it's a cost. Okay, the capital recovery is a cost. Why it is a cost? Because the initial investment of the projects are usually much higher than the final salvage values, final market values. That's why. Okay, so this is the same example that we solved using the present word and future word methods. Now let's solve the same example using the annual word method. Okay, so what was the idea? What was included in this example? We are buying an equipment for $25,000, for which the salvage value at the end is $5,000, and the net revenue minus expense, net profit at each year is $8,000. So how can we find this annual worth? And the MARR was given as 20%. So sometimes we write this like this, annual worth using 20% as the MARR. Okay, so if we write inside this parenthesis, this 20%, it is the interest rate or the MARR that we are using in our calculations. So this, let's start with this easiest one, which is 8,000. It occurs at each year. So this annual worth, for this annual worth, 8,000, we don't need to do any calculation, any operation. We just keep it as it is because it is already an annual equivalent. Now we need to find the capital recovery corresponding to this initial investment. And how do we find the capital recovery? So I'm going to add this second part to here. The capital recovery, again using 20%, will be equal to, first I'm going to find for this 25,000 its annual equivalent given this interest rate and the number of periods. And from this one, I'm going to subtract this 5,000. This time it is A given F because it's in the future. Again, 20% interest and 5. Okay, so with this formula, I will use the capital recovery. And then here, in order to find the annual equivalent, I'm going to subtract this capital recovery from 8,000 because this is revenue, but this is cost. please pay attention to costs and revenues and their signs. Okay, and after this you will find the annual equivalent. If the annual worth is greater than or equal to 0, we accept the project, otherwise we reject the project. Of course, for this capital recovery, instead of using this method, you can use the formula that we developed and also find the capital recovery. So this is the calculation. This 8,000 is already revenue minus expense. It is the net profit. This part is the capital recovery. So 25,000 distributed to annual equivalent, 5,000 distributed to annual equivalent. So this is I and this is S. And from here we find the annual worth to be equal to $312. And what is our decision? Since this is greater than or equal to 0, we accept the project. And as you can see, this decision is exactly the same with the previous decisions that we made with the present worth or future worth methods. And actually, the thing is, if you convert this future worth, this annual worth, into future worth or into present worth, or vice versa, we already calculated the present worth in the previous examples as this much. If you find it is annual equivalent, you will find exactly the same annual worth. Or, again, in the previous example, we find the future worth of the same project as this much. And if you find its annual equivalent using this factor, again, you will find exactly the same solution. So future worth, annual worth, present worth, if you are using the same MARR value, they will always give you the same decision. You will make the same decision. Of course, the values are different. Look, in present worth, the value is this one. In future worth, the value is this one. In annual worth, the value is this one. But what is the criteria? The criteria is all of them are greater than or equal to 0, right? It means that with all of them, we are accepting the project. And as I told you, the difference between these methods, which one to use, depends on the efficiency of the calculations. Sometimes using annual worth is more efficient because of the structure of the cash flow. Annual worth can be easier to calculate. In that case, you consider annual worth. And also, as I told you, if you are comparing two projects which have unequal lifetimes, then using annual worth can be preferable to present or future worth analysis. Okay, this is another example to demonstrate the annual worth method. Okay, in this, so in order to show this annual worth method, we are considering this example, and in this one it says that there's an investment company that considers building a 25-unit apartment complex. So in this apartment complex there will be 25 units. Because of the long-term growth potential of the town, it is felt that the company could average 90% of full occupancy. So 25 units of the apartment, and we are expecting that 90% of these units will be occupied. And if the following items are reasonably accurate estimates, so some estimates are given to us, what is the minimum monthly rent that should be charged? Okay, for these 25 units, we are going to rent them, and we are asked to find the minimum rent amount if the MARR is 12% per year. Okay, this is the desired MARR. It means that we want to earn more than 12%. It says that the land investment cost is 50,000, meaning that we are going to buy the land for this money. Building the apartment complex, the cost is this much. The study period is 20 years, so we will rent these apartments for 20 years. We are asked for the rent per month. It says that the upkeep expense per each unit in the apartment per each month, it is $35. And also we are going to pay property taxes and insurance each year, which is the 10% of the total initial investment. Okay, in order to solve this question, again, the first thing is to sketch the cash flow diagram. So when you sketch the cash flow diagram, the rest is just finding the present worth or future worth or the annual worth. It will go back to chapter 4. Okay, so how can we sketch the cash flow of this one? First of all, the project lifetime is 20 years. Okay, so we need a cash flow for 20 years. But be careful, some of the costs here occur at present time. Which are they? These. Some of the costs occur at each year. For example, this property taxes, it is per year. And some of the costs or revenues occur at each month. For example, the rent is per each month and upkeep expense is per each month. Okay, so now we need to have this consistency. And look, the interest rate is given per year. So this is the effective interest rate. If it is not effective, be careful, it will write here 12% nominal interest rate. If it does not write nominal interest rate, it means that it is the effective interest rate for the year. So it means that the compounding period is also 12%. So I'm going to represent the cash flow at each year. So initial value, initial investment that we are doing at the beginning is the summation of these two values. So it will be $275,000. Okay, this is the initial investment. What about? Let's go to this property taxes. It is the 10% of the total initial investment. Total initial investment is $275,000. 10% of it will be given as property taxes. So I'm going to represent it with a different color. And these occurs at each year for 20 years. And it will be $27,500. Okay, 10% of the initial investment. Okay, let's continue with the costs. Another cost is the upkeep expense, but it is per month. And it's $35 per unit. And how many units are there? 25 units. But the thing is, only 90% of them will be occupied. So for the unoccupied ones, you don't need upkeep expenses. So for 1 month, we will have $35 for 25 units, but the occupied units is 25 times 0.9, 90%. And this is for 1 month. But I need to find its annual value so that I will multiply by 12, and this will be the the annual upkeep expenses. So 25 times 0.9, then times 35 times 12, and this value is, let me write it here. I'm going to include it as a blue arrow here. Okay. Actually, you can represent it in this way. So in addition to these green ones, we have these blue ones, and those are $9,450. These are upkeep expenses. Are there any other expenses? I don't see. And what do we have? We have the rent. At each month, we will have a rent amount. Let's represent this rent by R. Okay, at each month we are going to collect this, and we will collect this from 25 units, but only 90% of these 25 units will be occupied. So we will collect rent from these many units, and it will be this much for 1 month, and for 1 year it will be this much. Okay, so if we multiply this 25 times 0.9 and multiply it by 12, then it will be the revenue, the rent at each year will be 270 R. Okay, and these are plus. Okay, what happens at the end of the 20 years? Initially we bought this land and we built the apartment complex. So in this question, although it's not mentioned, we assume that the apartment complex will not be useful after 20 years. So you will not be able to use it, you will just demolish it. Okay, but the land, which is 50,000, it will remain. So at the end we will have, let me use a different color, at the end we will have this salvage value of the land, and that land will not lose any value. It will remain the same, 50,000. So this is the cash flow. Now from this cash flow, what do we want? We want to find R so that we obtain more than 12% rate of return. And how can we find it? What is the idea here? We can try to find the annual worth of this cash flow using 12% as MARR, and we want this to be greater than or equal to 0, but it asks for the minimum monthly rental. So since it says minimum amount, at least this value should be equal to 0. Okay? So find the annual worth of this cash flow so that the annual worth is equal to 0. That's it. Now the question is solved. The remaining part, the rest, is just using the factor tables to find the annual worth. And how do we do it? Okay, the annual worth will be this taxes and insurance plus upkeep expenses plus the capital recovery, which is this much, okay? And this amount, if we divide it by the number of apartment units multiplied by 0.9, 90% occupancy, multiplied by 12, which is the annual rent, the total months in 1 year, we find this R to be $270. Okay, so this, if your rent amount is at least this much, you earn 12% from this investment. Annual rate of return earning will be 12%. If your rent amount is larger than this one, then you will earn even more. If your rent is less than this much, then you will earn less. You will not be able to earn 12%. Okay, so this was the example for the annual worth method and how can we use it. There is another important type of analysis in order to evaluate projects, which is called the internal rate of return. So this internal rate of return now is different than the previous methods. The present, future, annual worth methods, they all use the same idea. Using the MARR as the interest rate, find the present worth or future worth or annual worth, and if it is greater than 0, then accept the project, otherwise reject the project. But in this internal rate of return, now we are not using MARR in our calculations. Actually, what we try to do is we try to find the interest rate. Okay, so we assume that the interest rate is unknown. We try to find that interest rate, which makes the inflows of the projects equal to the outflows of the project. Okay, so when we find this interest rate, after that we will compare this interest rate with the MARR. Again, MARR appears in this analysis at this stage, and if the interest rate that we find using this method is greater than MARR, it means that we are earning more than MARR and we accept the project, otherwise we reject it. Okay, so the difference of this IRR method from the previous ones is now we don't know the interest. We are just trying to find the interest rate, and when we find the interest rate, we compare it with respect to MARR. Sometimes instead of internal rate of return method, we use this, we give different names to this method, either investors method or discounted cash flow method or profitability index. These are different names given to the same method. Okay, and this IRR, internal rate of return, sometimes you will not be able to find an IRR using this method in some project cash flows. Sometimes maybe you will find negative values for IRR. In order to be able to find a positive interest rate for a given project alternative, you need to have cash inflows and cash outflows at the same time. If the project includes only cash inflows, then how can you make cash inflows equal to cash outflows? If the project consists of only the costs, then there's no way to make these cash outflows equal to cash inflows. So it means that in order to be able to find a positive interest rate, then you should have both inflows and outflows, and also the sum of the receipts, I mean the inflows, should be larger than the sum of the outflows. Otherwise, again, your IRR will not be a positive value. So let's try to understand the idea of this internal rate of return better. So, you know, the Walmart is a grocery store series in the United States. It's a chain of stores, and it went public. I mean, as a person, you could buy its shares in 1970, in the 1st of October 1970. If you bought, for example, 100 shares of this company, you could have bought it for $1,650. And if you keep these shares for until 2009 of September 30 for 39 years, in 39 years, the value of the share increases to $10 million, okay, from $1,650 to $10 million. You can sell the shares for this price. Then, what is your rate of return from this investment? We can calculate it. How do we calculate it? Basically, the idea is this. In 1970, we are paying this amount to buy 100 shares. And in 2009, we are selling these shares for this price. And what is the interest rate that makes this initial present value to this equivalent to this future value for 29 years? Actually, it should be 39 years, right? From 1970 to 2009. Okay, and what formula do we use? Simply, it is making this present value equivalent to future value. So this is the formula. F equals to P times 1 plus I to the power n, and you would obtain this I to be 25%. So what is this 25%? It is your rate of return from this investment. And this is the annual rate of return. It means that your investment, each year, your investment earned an 25%. Is this a good alternative or not? Of course, you need to compare it with other possibilities to see if it is a good alternative or not. So, the first one is to invest in Walmart shares, and you will earn 25%. But instead of Walmart, if you deposited your 1,650 to a savings account, then you would earn 6% interest rate. Okay, only 6%. And the total amount that will be accumulated in your savings account after 29 years is $16,000. Okay, so on the one hand side, you have $10 million. On the other hand side, you have $16,000. So which one will you prefer? Of course, this one is more preferable, but go back to 1970. We are talking about past now. Now assume that we are in year 1970 and we want to make a decision. On the one hand side, there's these shares of the company, Walmart, but of course you don't know about this company. Will it be successful or not? When you pay this 1,650, will it earn or will it lose that money? You don't know it. But on the other hand, for the second alternative, you know that this bank will give you 6%. There's no risk associated with that one. So this one is risky. You don't know what's going to happen, but this one is not risky. So if you take the risk, you may earn this much, or maybe you will lose your money. If you take the second alternative, okay, this one, you will earn money, but you will earn only 6%. So what is the meaning of this 6%? It is the opportunity cost of this alternative. It is the second best alternative. Okay? It is the minimum return required. So if this investment percentage is larger than 6%, then you will want to invest on this alternative. Otherwise, if this earning rate is less than this, then you will go with the second alternative. So this 6% is actually your MARR, your comparison criteria for this example. Okay, so this 6% is the minimum attractive rate of return for this calculation. And since the internal rate of return from this project is larger than this MARR value of 6%, yes, this project is a good project and you would accept buying the shares of Walmart in year 1970. This IRR method, as I told you, it is different than the other methods, and also it's a popular method. So why it is a popular method? Because of this. So I am telling you two statements. The first statement is this. There is a project alternative, and this project will bring you a 15% rate of return on your investment. So if you invest 100, you will earn 115. If you invest 1,000, you will earn 1,150. So this 15% means that. But in the second one, the statement is this. If you invest in the project, you will have a net surplus of $10,000 net present worth. Okay, your net present worth in this project will be 10,000. Okay, so which one is more informative for you? To know the surplus amount or to learn the rate? In the second one, it doesn't mention anything about how much you are going to invest in the alternative. Is it $100? You are going to, the net present worth will be 10,000 if you invest $1,000 or $1 million or $1 billion. You don't know anything about it. So if you are earning $10,000 as a result of investing $1 billion, then maybe it's not a good one. But in the first one, when you know this 15%, you know actually what will be your net present worth or your surplus when you invest, or how much you invest on this project. Okay, that's why it is more easier to understand and it's more popular. It's used a lot in comparing project alternatives with each other. So let's summarize this internal rate of return method. What do we do, or how do we find this internal rate of return? Simply, we find the present worth of all the revenues, okay, all the cash inflow, we find the present worth, but of course we don't know this rate of return, this interest rate, and our objective is to find this. And we want these revenues to be equivalent to the present worth of the expenses. So for a cash flow, we move all the revenues and all the expenses to present time using this interest rate, and we want them to be equal to each other. And from here, you identify the interest rate, and if this interest rate is greater than your MARR, we select this alternative as acceptable. Otherwise, if it is less, we reject it. Okay, so we can represent this in another way. So simply, we find the present worth of the cash flows, revenues minus expenses, and we set this present worth equal to 0 and find the interest rate that makes this present worth equal to 0. And when we find it, we compare it with the MARR. So depending on different interest rates, the present worth will take different values. So our objective is to find the interest rate that makes this present worth equal to 0. If you use a lower interest rate, the present worth can be, let's say, positive. If you use a higher interest rate, the present worth can be negative. But we want to identify the interest rate that will make the present worth equal to 0. And this interest rate is called IRR, the internal rate of return. Okay, so